The US hits back with sweeping new tariffs, targeting goods from China and beyond. Some of America's biggest companies are now facing serious pressure. But which firms will be hit the hardest? And can they recover? First up, Apple. With over 90% of its products made in China, Apple now faces billions in added import costs. That's a massive short-term blow. But Apple isn't just any company. It has deep cash reserves, high margins, and is already shifting production to India and Vietnam. Short-term pain, definitely. Long-term, Apple's too strong to stay down. Next is Walmart, America's biggest retailer. It relies heavily on cheap imports, now subject to tariffs up to 50%. Either margins get squeezed or prices go up. Not ideal. Still, Walmart's scale and supply chain give it some flexibility. It's already diversifying sourcing, and while profits may dip, its long-term position looks safe. Nike is another casualty. Most of its shoes are made in tariff-hit countries like China and Vietnam. That means higher production costs and tighter margins. Investors were spooked. But Nike's a global powerhouse with low debt and strong demand. It'll adjust. The brand's strength makes long-term recovery likely. Now Boeing, a tougher case. It sources parts globally and faces retaliation from countries like China, which could cancel orders. Boeing's finances are already strained after years of setbacks. But with strong US government ties and a massive order backlog, it may just make it through, though the road will be rough. Finally, Tesla. Tariffs on auto parts could raise costs by up to $5,000 per vehicle. That's a big hit. Tesla's stock fell, and demand may soften, especially in China. But with solid cash, minimal debt, and a global factory network, Tesla has room to adapt. Long term, the brand and innovation still win. These tariffs may hit hard, but strong brands, solid financials, and smart pivots could be the difference between decline and dominance.